Let us look at the fourth transaction in your new business. You realize that you need to buy some basic raw materials, that is milk and ice, to make the ice cream. This would cost you another $350. Also, to do some marketing and advertisement, you decide to distribute pamphlets of your shop to the visitors of the mall. This costed you another $150. You decide to pay half of them in cash, and the remaining half you promise your vendors that you would pay in some time. Now, to record this transaction, we first have to record the direct and the indirect costs in the income statement that we have done so far. Whether we pay fully or partially in cash, we have to record the full cost in the income statement since we need to know the exact profits at the end of the year. So, we record $350 for the cost of the milk and ice under the direct cost head. We will also record the $150 incurred for marketing of the ice cream shop in the mall under the indirect costs of the income statement. This way, we have totally recorded for $500 of direct and indirect costs in our income statement. What about the balance sheet? Now, in the same transactions, we decided that we would pay half of the $500 in cash. Since we paid half of the total amount, that is $500 in cash, our cash balance will go down by $250. As such, the cash balance will reduce from earlier $1,500 to now $1,250. What about the remaining $250? Well, glad you asked that question. We haven't yet paid for the $250, but we have to in some time. Hence, we record this under the accounts payable of the liabilities section as it is some money that the business owes to outsiders of the company. When we record $250 in the cash balance and $250 in the account liability, we have completely accounted for the $500 that we spent on the costs, that is the direct and the indirect costs associated with the manufacture of the ice cream.